Well, US earnings roll in as we look ahead for what is a monster week of earnings risk ahead. We look at the US dollar, where after a period of drawdown, we are seeing buyers step back in, and we preview specifically moves that are taking place in the Australian dollar and the pound as well. It is going to be next week a monster week of event risk, and we preview it all here. It's time to get in front of the screens. This is the trade-off. Well, hello everyone, my name's Chris West, I'm Head of Research here at Pepperstone, and I am going to be joined in 2 seconds by Blake Murray from Forex Analytics. And as always, we will be going through all the setups that are going through these mad world of markets, the thematics, the vibes, the news flows, and the ideas that we like, as well as previewing the event risk that will be in the week ahead. And as always, if you find yourself liking the show, which of course you will be, hit the like button and leave us a comment. Last week we got a huge amount of comments, good, so many great views about what's going on, good questions. Do leave a comment and let us know how you're trading the markets. Anyway, Mr. Blake Murray, welcome to the programme. How goes it, my good sir?
Doing well, Chris. Trying not to melt over here, but I guess from what I hear over there, you're just trying to stay warm.
I'm trying to stay warm. I'd love to do a bit of melting, to be honest, but that's. I can't really grumble. I'm an Englishman, to be honest, so we grumble about the cold. But that's where it is. I think we're looking forward to the Ashes. I guess you guys don't look at that too much over in the US. It's more about baseball, isn't it? So
it is a little bit. And I'm assuming you're talking about cricket.
Cricket, yeah. Well, I'm torn because England are playing against Australia, so I can flip allegiances anytime I want. Obviously, a Pom at heart, but yeah, that's going to consume us for the next few days, I think. We'll see. Mate, anyway, let's. I'm guessing you have absolutely nothing to add on the Ashes, so I'm going to leave that one be. Let's move into the markets. Let's see where you obviously do have a strong opinion. Let's go into topical thunder and let's see what's going on in markets today. Well, I want to bring up the dollar. Last week, I guess we spoke about the dollar at length last week, and rightly so. Obviously it came through, it broke through the range. I've got a chart which we'll look at in a second, but we saw some incredible moves on the week, certainly against the NOKI, the Stocky, all these factors playing through, but the dollar got absolutely taken down. Huge activity from our clients, as you'd have probably seen through the broader market, obviously. And I think now we're starting to see the buyers step in. We've seen some consolidation in the Dixie and the dollar pairs. And I want to know how you're viewing the dollar. Is there one pair that you're looking to eventually buy? Are you looking to sell into dollar strength? How are you seeing this right now?
Well, let me just start off by saying that, we talked about this last week about the big breakdown of the dollar, and it was just starting. And we eventually got to a pretty key technical level. It's like 127% extension. We reached it early this week. I am looking to actually sell rallies at this point until proven otherwise. I mean, I've heard a lot of people say, the dollar's overdone and it should, it should turn. And I am long some dollars. Don't get me wrong. I'm actually long some dollars against currencies that are faring better at this moment. But, because the dollar index as a whole, it's not one size fits all feet, if you will.
That's right.
So, with the dollar, I think you got to be a little careful if you're looking at like the, non-commodity type of currencies. I mean, we're obviously seeing the sterling pull back after the inflation data, but you got the euros that's perched well above 111. And while we're above 111, it's really hard to be super, super bullish the dollar. But like I said, I think there's some shiny spots across the spectrum if you're looking at the dollar.
I want to have a look at dollar yen because, I think part of the move down that we saw last week was sort of idiosyncratic issues such as the PBOC pushing back against the yuan weakness, but now we've seen dollar CNH moving higher, and I think that's really important. Last week there was a lot of people betting that we would potentially see tweaks to yield curve control from the Bank of Japan next week. Maybe that's they target the 5-year duration as opposed to the 10-year government bond, or maybe they widen the band from 50 basis points where they're capping 10-year JGBs to 75 or even 1%. But I think that's now come off the table. I think people are pushing back on that and saying this is probably more an October thing now. And yields are starting to move a little bit lower. And I think some of that still needs to unwind. So I wouldn't be surprised if dollar yen makes a stage up to 140, maybe a little bit higher from that point. But yeah, obviously we watch next week with the Bank of Japan meeting potentially so influential in that situation. So if I'm gonna trade the dollar now, I want to do it against the yen. And I think the pound's interesting as well. I still think that with a terminal price of 5.85 on the bank rate, I still think that's too high. But that said, I wouldn't necessarily be shorting it right now. But I think the yen's probably the interesting one. I see the probability that they leave policy unchanged next week as quite high now, and therefore I think there could be some upside in dollar yen if I was going to play it that way.
Well, all my European colleagues and all the people that I know that trade during the European hours predominantly, they're going to stay up late for the BOJ next week. And I know I'll be around for sure. There's no way I'm going to miss that one.
Well, it's going to be pretty late, isn't it? I'd imagine it would probably be late Asian afternoon. That's usually when this usually takes place. So, get some of that Red Bull out.
North American traders, if you live in New York City, you'll be up around the midnight hour, I'm sure. So it's going to be a late night for a lot of traders, but it's going to be such a big event that we're all going to be trading around it. I know that's the one I really want to be around for.
All those party boys out in New York, eh? The party lads.
That's right. That's right. They're going to have to sit down the drinks early, or they can trade while they've been drinking under the influence, but I don't know if that's such a good idea. So anyway, hey, let's turn it to our next topic, and let's talk a little bit about earnings. As you rightfully said, we are kicking off earnings season. Next week's going to be a big week, but I kind of want to talk about some of the earnings that are between now and next Wednesday, since we're going to be coming right back into earnings, like in another earnings week. But just a couple of the highlights, and I want to ask you, after I'm done with just naming off some of the big ones that I've found, how important is it to you going into this earnings season, looking backwards at company earnings? Do you think this is going to be the quarter where you start to see some earnings shortfalls? But you can answer that just in a second. I wanted to say tomorrow we get Taiwan Semi. We've got J&J. We have American Express, Schlumberger on Friday. Then going into the next week, Microsoft, Google, Visa, Louis Vuitton, Texas Instruments. That's on Tuesday. And you might ask me, well, why Louis Vuitton? And one of the reasons why Louis Vuitton is if you saw Richemont this week get absolutely destroyed because of China demand. It was down like 10% last I looked. I looked at it a couple of times during the day and then I stopped looking at it. But, we'll keep an eye on Louis Vuitton as a result of that. You got Meta, Coke, Coca-Cola, I think Coca-Cola, Boeing, Qualcomm. That's on Wednesday. And then that's going to take us into our next trade-off. But there's some big names that are coming up.
Mate, 49% of the S&P market cap report next week. It's the big one, right?
Yeah, right. And
most
then,
of it's going to be on the tech side.
There are, and then we have like Amazon and MasterCard and McDonald's. These are all obviously U.S. based companies, but a lot of earnings. But going back to my question to you originally, is this going to be the earnings quarter that we start to see some misses? Or do you think it's going to be the following quarter? Because I personally think it's going to be in the next quarter.
Maybe, yeah. I mean, I think I want to take your point about Louis Vuitton because European equity markets for such a large period of time had been buoyed up by these high-end retail names. But also next week, if we add that into the mix, and you're going to be looking at, I think you really need to look at SAP as well. So they're going to be coming out tomorrow, and SAP in Germany have a near 10% weighting on the DAX. So anyone who's out there trading, the DAX, the Germany 40, this has a 10% weighting on the market. It's the big stock there. So, they will be coming out of earnings just after the market close. And that could be very influential for the DAX. But I think next week, we've got the NASDAQ rebalancing taking place over this week where we're going to see those 7 big names having their concentration down. We'll see if that has an influence on the beta of the NASDAQ going forward, whether it slows the pace down a little bit because so many people have been buying those, Nvidias, the Apples of this world, and maybe that changes the pace. Does it affect the price action? We'll have to see. But we do get, the big names next week coming out. Now, I think Netflix was really interesting after market. The stock has been in such a beautiful uptrend. It's one of the most textbook uptrends you'll see. There was stuff to like about the result, and there was stuff that disappointed. The stock's down after hours as a result of their guidance. But I think this is it. I think the guidance needs to be there. If you've had a really strong run in tech and discretionary, for example, and you don't hit the market after you price to perfection, you're going to get hit pretty badly from the market. So you need to deliver after what we've been seeing, I think, is the bottom line.
There you go.
There you go. I want to touch on the big week there because, next week we are risk managers. That's what we do as traders. We manage risk. We get our position sizing right relative to the volatility and the size of our account, and those factors. They're obviously the primary thing that keep us in the game. But next week, I want to preview this because it is a big one, right? So we've got the Fed meeting, which we can touch on a little bit more in depth in the next segment. We've got the ECB meeting. We've got Aussie Q2 CPI, which you've got about 10 basis points being priced in for the 1st of August RBA meeting. I think that's going to be the nail in the coffin. I know we're saying this now before the employment data in Australia, but you've got Q2 there. You've got obviously the earnings season we talked about there. We've got the start of the Australian earnings season as well for those Oz 200 traders. And then I think you've got the Bank of Japan meeting as well on Friday. And we don't have a set time for that, which we can debate the merits of a central bank who don't give us an explicit time to work with, and obviously annoyance to your New York traders. But I think there's something in there for everyone. Where do you see the balance of risk? What specifically are you looking at within these as the potential big catalyst there in terms of volatility drivers?
Well, like you said, in the next segment, we're going to talk about the FOMC, and I wanted to get that in just since we're going to be meeting after the FOMC next week. But, we got a lot of PMIs coming out next week, early on, a lot of European PMIs. And we've seen, a lot of those PMIs, both manufacturing, some of the service sectors are still hanging on, but they're gone into contractionary territory. And that's a concern. It's more of a concern that they're it's not as much of a concern that they've dipped in a contractionary territory, but how they're staying down there is a bit of a concern. Also, at the end of the week, and I know we just had US CPI, and I know it's not really going to matter for the Fed because it's after the fact. We also have the PCE data that comes out at the end of the week here in the US, and that's another thing that we'd be watching. And obviously, you mentioned the ECB. Why shouldn't we be looking at the ECB? The currency market right now is completely focused on where rates are going to go from here via every central bank, and you're starting to get a little bit of concerns, as you mentioned, with the sterling and the Bank of England. You got the Bank of Japan that could be shifting. How about the European Central Bank?
Well, can I just point you in there? So we heard Governor Knott from the ECB Council speaking this week, and he's a hawk, and he came out and said, there's no guarantee we're going to raise rates a second time, and he's put that element of doubt in. The market is saying that we're going to get a 25 basis point hike from the ECB. That's a done deal. I mean, that's not even really up for debate. But the question is do we get a second one now? If we go into the market pricing, there is a second hike being priced in for later in the year, and that's just a sort of a token. We're data dependent. That may not happen. But I want to ask you a question before we go into the next segment, because you talk about the fact that we're still focused on rates and various factors. But with PMIs next week, I think, if you take the UK, for example, if we start seeing chinks and cracks emerge in the service PMI, which takes the composite number down, that to me is when we start. That's when we start talking about the new paradigm in FX markets. Once we get to the end of the rate hiking cycle, which we're pretty close to, for me, FX just becomes a relative growth play, and that's what we're going to be looking forward to. So we're going to be looking at those PMI numbers specifically on the service side, and we're going to be trading relative growth differentials, I think, because you're going to have that higher for longer. You're going to be in restrictive territory, and then it's really down to which economy starts to crack first, if at all. And I think, those PMI composite numbers are going to be really what could really drive FX markets into the second half of this year. Agree or disagree on that one?
No, I agree with that. And then you take the UK economy, which, I mean, you're in a stagflationary environment, right? I mean, I would be looking at, and that's when you start looking at the suspect sterling, which is trading at 129
exactly,
and change, and you're like,
well, I think that's it, because the pound's held on well because of a high interest rate environment. But if we start seeing that actually, it might not happen, and it might take a while to really, one data point doesn't make a trend, of course. But if we start seeing some of the data points and start to fall away, and we actually see it impacting growth, then I think you got that. That's when the pound shorts really start honing in and going. You got high rates, the stagflation's biting. Now we're starting to see growth, especially on the service side, start to crack. It's not happening yet, and that's why we're going to be watching those services PMIs and the composite numbers. But if you do start seeing that trending lower, I think that will be your cue to really take some in. And remember, positioning in the pound is as punchy as it gets. Anyway, let's move on.
All right, punchy, being long, meaning long. Okay, let's take it to the last topic and let's talk about the FOMC. Since it is, like I said, it's going to be next Wednesday, and so we'll be meeting here right after the FOMC. And the question I'm going to have is to you is, does it really matter? I mean, everybody's pricing in a quarter basis point hike, and I think that's where it's going to be capped. Everybody thinks this is the last move of the Fed. Then we're going to be in wait and see mode and see how the economy fares moving forward. But how important is it to you next week? I mean, I think other central banks are going to be more important. I think the Bank of Japan, obviously the ECB, but the Fed, I don't know if it's going to be that important. But I also want to I think you should take those words with a grain of salt, depending on where the dollar is at, because if the dollar is trading down here at these levels, let's just say, arguments aside, dollar still below 100 on the dollar index, I think the risk of a snapback rally, of maybe the Fed being a little bit more hawkish than the market wants, because the market wants to hear the Fed saying, okay, we're done. We could pivot at any time. And, we could loosen policy if we wanted to. I don't think they're going to get that from the Fed. And then there's a risk of a squeeze. Yeah. So I think the dollar, again, depending on where it's trading at 1 week from now. But what are your thoughts regarding the Fed?
Well, I think very simplistically, the Fed are not going to give themselves a high five and say we're done here. They're not going to celebrate their successes at this point. This is not the moment they do that. So they'll still continue to be hawkish at this point. I think if you go into the market pricing, a rate hike is a done deal in the market's eyes here. Most economists are calling for it, but the market's pricing in 24 basis points. So it's a done deal. Where we look at is for November, for example, we've got 36 basis points in aggregate in cumulative pricing. So we've got, about a 36% chance that they raise a second time there. That's where you can get very interesting. And actually, if you look at SOFR markets for 2024, we've got 140 odd basis points of cuts being priced in, which is part of the reason I think the dollar's been sold, is because the market's saying in 2024, from around March, the Fed are going to be the first G10 central bank to start cutting rates, and they're going to do it much more aggressively. I think simplistically they'll they'll tell people they've still got a hawkish bias. It comes down to inflation then. And I want to look at it rather than on a year-on-year basis, because a lot of the base effects have come out. The disinflationary ease has happened. I think you've got to look at core PCE on the 28th, as you say. Anything around 30 basis points would be dollar positive, and see them look to raise rates probably November. I think you go into the CPI print on the 10th of August. If we get core month on month at 30 basis points, I think that means that they raise rates in November. I think it's as simple as that. 20 basis points month on month, and that's then probably done for the year. But I think it's just take the month on month clip for PCE and CPI. If it's 20 basis points month on month, I think that's then probably done. If it comes out 30 basis points, which raises the year on year clip, I think that they go again, and they'll look to go again in November. And I don't think that's priced, and I think that's where you get your dollar rally. So I think they come and tell us that they're in the mood for raising rates if the data's there. And then we come down to those CPI prints and the PCE, and it's down to the month-on-month clip for me. That's just the very simple playbook I'm working on right now.
Fair enough, and I'm glad you're here to guide us there, Chris.
Thanks, buddy. All right, let's go into that's the setup. Well, we've been talking about the US dollar, and I want to bring up the daily chart of the Dixie. So as Blake pointed out, difficult to do anything with the euro at the moment. There's a little bit of pound in there, and there's a decent component of the yen. But we obviously had the range breakdown through 100 spot 50. We traded lower, obviously, on that ferocious move lower, that big liquidation of dollar longs that took place. But we're back testing that former range. So the question is what happens here? And this is what we do as traders. We obviously work on how markets react around levels, and we react to that situation. So we don't know the future, of course, Blake, but we work on probabilities, and that's what the options market tells us, is how to think in distributions. Where do you see this going now? Are we selling into this level? How do you see this? Do you see the sort of balance of risk pushing back inside that range, and then maybe a move back into 101, 50, 102? That I see that as a slightly higher skew. How are you seeing this?
So as far as the dollar index goes, I do, like I mentioned before, I have dollar longs and shorts on. I'm playing both sides of the market right now just because it is a bearish breakdown technically, but I think you got to pick your battles and know where your levels are at. Again, as long as the euro's trading below 111 or above 111, excuse me, I think the dollar's in breakdown territory. If the euro starts to break back below 111, maybe coming out off of next week's PMIs before the ECB meeting, if those look a little weak and the euro starts dipping lower, the dollar is setting up for a false breakdown. And then you got to be looking for an absolute reversal across the board. And I think the dollar, I don't want to say it's oversold, but we are very close to a weekly 618 retracement, which comes in at 99.05, 99.06. And that's really the the end of 2020, early 2021 lows to the highs in September of last year. So the 618 retracement golden fib level just slightly below the market right now. So it's hard to be super bearish either.
Yeah, exactly. I think you've got to look at the rates market. As I say, 140 odd basis points of cuts being priced in. Yeah, it feels a bit rich to me. I think there's too many there. But then also we work on rate differentials between 5-year government bonds and ECB bonds and European bonds and UK bonds, and also on a real basis as well. And I think what we saw last week was US bond yields moved further away or closer towards other markets, and that reduced the carry that came into the market. So I think we've got to keep our eye firmly on that. But for me, the rates market for next year is really interesting. Are the level of cuts that are being priced in just too aggressive, or are they priced right? We obviously don't know yet. That inflation numbers are going to tell us, but I think the dollar's really keying off that.
I really think they're too aggressive personally. So and I so in that vein, I'd be looking to buy the dollar, but that's why it's a setup, and it's a great setup, Chris. I love it that you brought up the dollar index. All right, my next setup, or my first setup, is going to be the Apple chart, and it's not rotten to the core. And it's funny that the producer and he does a little bit of trading himself and has for the last few years, and he looked at this chart and he's like, wow, what an ascent. And that's right. The Apple's broken out to the upside today. It spiked up right to the 127% extension of this whole entire chart that you're basically seeing. And the reason why that's so important is it hit the top of the ascending wedge. Now, does that make the Apple chart meaning that it's bearish or it's going to reverse? No, but being that it's in an ascending wedge, you have to be looking at a potential reversal up at these levels. Obviously, the lower trend line that comes in right around the 190 level would signal that maybe we might start to get a reversal. We have the RSI is divergent. And also keep in mind, this is peak AI. That was off of an AI headline as well. So anyway, just want you guys to be following Apple right around here. It's still bullish, but and they don't have earnings until August 3rd. So what are your thoughts on Apple here?
Yeah, I mean, I did see the headlines coming through, and I didn't listen to what everything was going on, but I don't think they've reduced they're looking to talk about their AI solution that sort of marries up with what we were seeing with Bard and the various factors. But I don't know if we got a huge amount of context around that's certainly enough to give us an understanding about how that's going to impact their earnings going forward, especially when they're making all their earnings in iPhones and various factors. But the market will be very keen to explore about how they're going to sort of roll that out and into the earnings call. I do think that some of the upside is capped now because of the NASDAQ rebalancing and the reweighting that's going to take place, and obviously the concentration risk that's taken place between these big 7 stocks. But obviously, as goes Apple, as goes Nvidia, as goes the NASDAQ. So we'll be watching this very closely. So if you're an index trader, you'll be watching this one. But would I be shorting it right now? Well, it's very, very aggressive to be short into this ripping uptrend. So I'd want to see, price roll over a bit, and then I'll be short then, hoping that price can accelerate. But to do it right now, it feels like a pain trade. I wouldn't want to be doing it. So as I say, I want to see conviction that the buyers are drying up. The sellers are going to dominate right now. Is not the time for me, from a conviction perspective, to be short this name, but even though you've got the big technicals there. So I like shorting stocks when volatility rises, when there's a bit of uncertainty, and then the buyers step away. That's the time when you get those big moves down. That's when the order book dynamics take place, and that's where shorting works right now. We're not seeing that in Apple, but it may change, and that's when you can look more prominently at that situation. Anyway, let's go to the Aussie dollar. I want to say the Aussie dollar is an interesting one because we've got employment data coming through in the session ahead. Next week we get CPI numbers in Australia, and I think those CPI numbers for Q2 will dictate whether the Reserve Bank in Australia will raise rates. At the moment, the market's saying on balance, we're sitting on the fence. It could go either way, but the RBA are fully data dependent. Philip Lowe, who obviously steps down in September and was replaced by Michelle Bullock, has made it very, very clear, as we saw in the statement, that they will react to the employment data and the CPI numbers. We don't know at the moment, so we are dictated to by the data. But the chart at the moment is telling me that we've got a beautiful range. In fact, we've got this incredible double top that's taken place around 70 cents or so, 69 cents. And then we've got the lows on that situation. So we've tested the midpoint, the 50% retracement of that range. And so I'm interested, Blake, where you're seeing the balance of risk in this pair at the moment.
Well, first of all, I need to start and say that I actually got caught on the short side of this. When the dollar broke down, I had some short Aussie dollar. So when it spiked above the 200-day moving average, which is around 67.10 or so, I ended up getting out of shorts. And you're right, it's technically forged out a really nice high, and the 69 cent level is going to be really, really big resistance. Now, support is back down at the 200-day moving average, which, like I said, is just above 67 cents. I think that's where the rubber is going to meet the road. I don't like how copper is trading right now. I don't like how China is trading right now. So therefore, I don't like how the Aussie's trading. If you look at like the dollar, how it's broken down against the sterling and the euro and, the Swissy, you can see like the dollar just getting blasted, where the Aussie, it's actually holding up a little better. I mean, if I was long Aussie dollars, I'd actually be a little concerned right now that we might slip back, towards 66 cents. So I think it's a good setup if you want to play dollar longs, especially if we get a little bit higher volatility and maybe a little bit of risk off.
One of the things I say is, if you look at the 5-day exponential moving averages turning lower, prices below that at the moment. So I wouldn't really want to take longs until we saw them, start seeing price back above those levels. But one thing we do need to consider about for next week, and I missed it out on the week ahead, is that we've got the Politburo meeting in China. This is where the big heads of states, the big decision makers are getting together. Should come out sort of Friday into the weekend. So maybe there's some gapping risk the week after, but we can talk about it next week. But let's consider that they're getting together. The market is expecting some fairly punchy stimulus measures to be announced by the Chinese officials. On the fiscal side, maybe give the cat out of the bag that we're going to get reserve ratio cuts coming through in Q3 from the PBOC. But the market wants to see tangible stimulus coming through. And they need, expectations are elevated. So you may well see, I'm not going to say it's guaranteed, but you may well see Chinese assets and the proxies rally into that event, because you don't want to be necessarily short if they come out with some very powerful stimulus measures to play through. So that's something that you do need to consider if you're trading, the CNH, the Chinese yuan, Chinese equity markets, the Hang Seng, H shares, various factors, and also your copper and your Aussie dollars. That we've got this big meeting next week, and the market's expecting a raft of headlines around stimulus to do it. So you may well see Chinese equity markets and proxies rally into that. We'll have to see.
Oi, let's move it along. All right.
Hey. That's it.
All right. I'm going to take it into the last setup, which is cotton. And it's, I meant to mention this when we were going over Apple. I brought you some non-FX setups today. And the reason why I do that, I know most of you are not US based traders. If you're a US based trader, you have to have futures account, options account. You have a margin account. Hey, look, if you're outside of the U.S. and you have a Pepperstone account, you can trade CFDs here, and there's a CFD on copper, on cotton and copper too, but also like CFD on Apple, which makes these types of instruments really easy to trade. But I want to talk about cotton because I was having a conversation with another trader earlier today, and we were talking about inflationary pressures and these extreme weather patterns that might really fuel the inflation narrative in the months ahead. But I was looking at copper as one of those lagging commodities, and I'm not a big cotton trader, but you'll notice that resistance that's capped us right around the 24% retracement or 23.6% retracement at 89.20. It's a big level. And what you'll also notice is the 50-day has crossed over the 200-day, which they call that a golden cross. So, that pivot around the $89 level in the CFD, I think that's going to be a big one. It stays below it, you could short it, stay with the trend. It breaks above it, maybe get a bit of a squeeze. But Chris, what are your thoughts on, if you have any thoughts on cotton?
I don't have any thoughts on cotton. Not from a fundamental perspective. I wouldn't have any idea about that, to be honest. But I love the setup. I mean, I don't think you need to understand the fundamentals to understand that the market's just lacking something right now. And, you've got that volatility pulling away. So I'd probably, I'd be looking to put a Bollinger Band on that one and look at the squeeze that's taking place. Because I love, when you see these kind of, these moves that are sideways for a large period of time. I mean, this has been going on since September. That when you get that volatility really contract, when you finally do get the breakout, it can be very, very, very powerful. And the duration of this consolidation is very much there. So I love this as a setup because the longer this goes on for, the longer that volatility coils in and suppresses, that when you finally get that breakout, it's often very, very meaningful. So put it on the radar. I've got this now on my radar. Thank you for bringing it up, because if this breaks out, I don't think you need to know what the fundamentals are saying. The market's going to tell you that they're seeing something, and the price could trend. And that's what we do is, whether you're running a momentum strategy or a trend following strategy, it often starts with a breakout, and it has to start with a breakout in many cases. So you'd be looking at this and saying, what is the propensity for this to trend? You buy, it might get stopped out, or it might just go and go and go. So that's what I love about this. So the fundamentals are there for this when it does finally complete to go on a ripping trend. So thanks for putting this on the radar. Anyway, let's go to play of the good man. Let's go to play of the day. I want to bring up the Oz 200, the ASX 200 as a CFD. And why do I want to bring this up? Well, because valuations are getting a little bit rich now. We've had a nice move up to about 15.5 times, which historically is not overly significant, but we were so masked by what we saw in 2020 where valuations blew out significantly. But we are seeing earnings dropping in the last few months. We are seeing earnings revisions down, and that 15.5 times for the market is starting to get quite expensive. We've also seen the market internals in the ASX really pushing up. There's been good participation in this rally that we've been seeing from the lower end of the range of 70-50. I mean, we've got the number of companies above their 50-day moving average, 20-day moving average are pushing up to levels now. We're starting to flash a little bit higher. The number of companies at 4-week highs have pushed up quite nicely as well. And from a market internal perspective, we get into the top end of that range, we get expensive on a valuation perspective, but we get to the point where the market internals are flashing, starting to flash red a little bit. And the fact we've got the range highs as well, I think this will be a level that people want to sell into. So I'm looking at those range highs from a valuation perspective. I'm looking at it from a market internal perspective, and also from the fact that the market has been holding this range for many, many months. I'm looking at price action into 7,400 and just seeing, if there's going to be shorting opportunities here. I think that's probably where we'll be looking to fade it.
Awesome. Well, I love range trading like that, especially when you start talking valuations being a little rich, which they definitely are in the US as well. All right, Chris, my play of the day is going to be the guppy, the pound yen.
You love it.
Well, this one's a channel break, and this one is, I'm actually going to talk my book. I'm actually short pound yen right now, and I'm actually short right at these current levels right here. But I'm going to teach you how I trade some of these reversals when you come out of a channel, or you get a trend reversal. So what I'm already doing right now is putting one toe in the water. I'm basically trading, let's just call it one lot. I'm trading one lot. Whatever one means to you, it's just a single lot. And if the trade reverses and we get back above 182.5, then I'm gonna get squeezed out. I only lost one lot, or only lost a little bit. But if we break down below 179.50, I start adding. Once I add, so let's say I add another lot, now I have two lots, my average is lower. I'll move my stop to break even and look for an acceleration below 179.50, hopefully below the 200-day moving average. If we get a little lucky with the Bank of Japan next week, and they tweak yield curve control, maybe we trade down to the 200-day moving average in the following couple weeks. Then you got a sized up position in a reversal, and that is how I trade reversals. And the pound yen is squarely in my book.
I don't like it fundamentally, and I'll tell you why. Because I think that I think the Bank of England will raise by 50 basis points with pricing in 36, and I think that the Bank of Japan will leave yield curve control. But what I think and what actually happens are two different things often. But yeah, if the Bank of Japan do come out and tweak yield curve control now that expectations are being pared back, sterling yen could get absolutely taken down, and your trade's going to kill it. So yeah, I think there's a few things. Fundamentally, I don't like the trade. But what we're positioning around data is a difficult situation, and price is always what we're trading. So I like the setup, and I agree with your setup. But I think fundamentally, it's a tough one, isn't it? So we'll see. We'll see.
It is.
Anyway, thank you.
The ones that make you go, the ones that make you puke, that sometimes can end up being the best trade.
They can be. But yeah, we've been surprised so many times with Bank of Japan. These are one of the central banks, unlike the Federal Reserve, who do like that element of surprise. We go back to January, everyone was expecting tweaks to yield curve control there. They didn't do it, and we saw the yen coming off pretty hard on the back of that. We went back to December where we actually saw the yield curve control being changed. No one was expecting. This is a central bank that still likes to surprise the market, unlike the Federal Reserve, who like to keep volatility around these events with their guidance very, very sanguine. So, yeah, if we are going to get surprised by a central bank, it's probably going to be the Bank of Japan. So, could fit your trade nicely. Anyway, thank you everyone for joining us, staying on this long. Hit the like button. We know you want to. Please, and leave a comment as well. That also helps the program going forward as well. And Blake, good to see you, my good man. And we'll be back next week for what hopefully will be a very lively week in the markets. We'll see you then.